All right, we got some big news for Adobe stock investors as the company's management team reported a quarter that exceeded expectations both on the top and bottom line, and the company reported remaining performance obligations that exceeded its revenue growth. That's a key indicator I like to look out for companies that have this metric where they generate remaining performance obligations because they sign long-term contracts with customers. So I'm going to share those details with you in this video. I'll share with you my updated discounted cash flow valuation, which increased Adobe's intrinsic value per share after I updated my cash flow expectations for this company over the next decade. So I'm going to share all that with you in this short video. Let's get right into it after a brief message from my sponsor.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Adobe's management team said that they exited the quarter with remaining performance obligations of $20.44 billion, and that was up 13% year over year. Now, that was ahead of the company's revenue growth rate, which was around 10% year over year. And the reason why I like to look for companies that generate remaining performance obligations ahead of revenue growth, because remaining performance obligations are contracts that a company signs with its customers for long-term deals, and these eventually turn into revenue. So if a company is generating remaining performance obligations growth that's ahead of revenue growth, that signals a growing demand for a company's products and services, or an increasing rate of increase, a second derivative that's likely to increase. And that means that there's organic demand in the market for a company's products, that there's reasons and causes that's creating demand for the company's products and services to increase. And I always like to see that. Of course, I devote an entire chapter in my book on the customer value proposition because I see it as an integral part for investor success. When a business offers a good value to their customers, it's very likely that they're going to sustain revenue and sustain revenue growth and maintain competitive advantages. And this is one sign that a company has a great customer value proposition. Adobe's management team also said that their cash flow from operations in the quarter was a record at $2.2 billion. And their ending short-term investment position ending Q3 was $5.94 billion. So they have an excellent balance sheet and they generate over $2 billion in cash flow every quarter. Now, I've suggested that the management team should increase their investments in research and development to create products and services that allow Adobe to maintain its competitive position in a rapidly changing technological environment with artificial intelligence disrupting many industries. Still, the company is spending a lot of money buying back stock, which I usually see as a good sign because that signals that the management team believes their shares are undervalued, which I agree with Adobe. I've been saying all year that I believe their shares are undervalued. And in the third quarter, they repurchased $2.5 billion of their own stock, and they have $8.4 billion remaining for their repurchase authorization. So they're likely to continue repurchasing shares at this elevated level because the stock price is undervalued and the company has allocated a budget to repurchase these shares, so they're likely to continue this trend going forward. By the way, this document I'm reading from is Adobe's recently completed quarterly earnings call transcript with Wall Street Analyst. I've made this document available for my channel members, and you can join our channel for less than $5 a month, where you can get access to dozens and dozens of these highlighted earnings call transcripts, as well as many other benefits. See the link in the description for all the benefits you get for joining our channel, and this is only one of them. So I mentioned that I believe Adobe stock is undervalued, and one of the ways I figured that is by calculating a fair value for the stock using the discounted cash flow valuation model that I created myself. This is my own proprietary valuation framework. So this framework, this analysis, came to the conclusion that Adobe stock is worth $415 per share. The current market price is only $346. So even if I account for a margin of safety, which I always do, I always apply a 5 to 10% margin of safety, sometimes higher in more volatile stocks, to account for the fact that maybe some of my estimates and assumptions are off. And so maybe my calculation in my model is off. So I apply a margin of safety there to account for maybe some numbers that I overestimated or underestimated. But even after accounting for the higher end of my margin of safety at 10%, the stock still looks undervalued based on my valuation framework. So I agree wholeheartedly with the management team that the stock price is undervalued at the current market prices. And I think those share buybacks are reasonable. And I think investors have an excellent option here with Adobe stock. I have it rated as a buy myself. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.